Well, welcome everybody to the February FMD Investment Committee update. Joining me as usual is Richard Dale, Chair of the FMD Investment Committee. Thanks for joining me, Richard. And Mike Reynolds, Investment Committee member and advisor in our Melbourne office.
Thanks,
Well, gentlemen, today what I would like to do is to have a bit of a look back over the calendar year 2023, where we got to compared to where we thought we might get to, and then look a little bit towards the positioning of the portfolios for the 2024 calendar year. So, Mike, might start with you. I guess we were hoping for a soft landing in 2023. What happened?
Well, I think we managed to navigate that path and ended up with a relatively soft outcome. Markets were pretty challenged for the majority of 2023. It was really backdropped by the fear of central banks continuing their monetary tightening cycle, and that uncertainty around how much further interest rates would rise really created an uncertain investment environment, and markets don't typically like that. So as we got towards the end of the year, September was a pretty ordinary month for most markets, and then the early part of October the same, and then all of a sudden we got this sense, and it was really more a reflection of the change of commentary from central banks, that the market interpreted that we were at the end of the interest rate tightening cycle. And so November and December were outstanding months for pretty much all asset classes. The chart that you will see on your screen really identifies the point where longer dated interest rates sort of reached their peak. We had a then material decline in the 10-year bond rate, almost 100 basis points in the US. And that coincided with a really, really strong rally in equity markets, fixed interest markets, listed real estate assets, etc. So a lot of the returns that we generated for the year came in the last couple of months of the year. And that's really a reflection of patience and holding your nerve during periods of difficulty. We talked all through last year that we thought investment markets would remain challenged until we got a change in the message from central banks. And that's exactly what we got. We got a change in central bank behaviour. The head of the US Federal Reserve, Jerome Powell, basically indicated that we would likely see some interest rate declines in the second half of this year, 2024. And markets have become much more accepting of that the soft landing has been achieved, remarkably so.
So, Richard, there were quite strong returns for the AMS funds across the year as a result of that. Is that right?
Yes, as Mike indicated, particularly those sectors which were sensitive to interest rates, and when market was perceiving that interest rates were going to stay higher for longer, right up and through till October. The sectors like the property area, real estate investment trusts as they're known, international shares, Australian shares in particular, and those longer dated companies as well, growth companies in the portfolio were challenged. As Mike said, when the markets perceived that interest rates in 2024 would come off, you had a rally in what we call bonds or government bonds. And that really facilitated a strong rally in real estate investment trusts. They were up double digit in December, and equities were strong, and even fixed interest itself, government bonds rallied as well. So we ended up with the calendar year of 2023 in the balance fund of 12% return. So it was certainly looking challenged earlier on, but a pleasing end to the year, Lee.
Yeah, thanks, Richard. Mike, lots of talk in America about AI. The Magnificent Seven led the charge from an equity perspective in the US. Is that right?
Absolutely. I think if you look at the index contribution, the Magnificent Seven, as it's so called, which is really Meta, Amazon, Apple, Microsoft, Google, Tesla, and Nvidia, really contributed a massive contribution to the performance of the index. And some pundits are arguing that the valuations of those companies are extreme. We probably have a little bit of a mixed view on that. I think there's sectors that are clearly expensive, but artificial intelligence and the effect, and we're using it in our business, or we've been trialing using it in our business. The productivity gains that potentially come from artificial intelligence is real, and and potentially a significant change in the way businesses operate in the future. So that's been a massive contribution in terms of returns. Interestingly, on the opposite side of that, the broader market, which is particularly what we would call the small and mid-cap sector, didn't attract the same level of appreciation that those 7 companies did. And I think that that's a sector of the market that looking forward to for the rest of the year, where there's perhaps some opportunities that are appearing in that space.
Yeah, and we might come back to the outlook and where those opportunities are in a little while. But before we move to the outlook, what about the risks at the moment? Risks of inflation, Richard? Where's that sitting, and what do you see there?
The outlook is mixed. The markets ebb and flow when inflation numbers come out strong. The markets pull back a bit. There's certainly still wage growth. So I think the US economy is still strong. The US Federal Reserve is holding interest rates where they are at the moment until they get some sign that inflation and wages will abate, Lee. So at the moment, strong economic growth is underpinning that. And so interest rates for the short term will be remaining where they are.
Commercial real estate, you talked earlier, Richard, about real estate investment trusts having a strong rally towards the end of the year, and that was, I assume, interest rate related.
Yes.
Are there still risks in that commercial real estate area?
Oh, look, I think there certainly was concerns with what happened with commercial real estate, with people working from home and what was happening to offices. In the listed market where our portfolios invested, there was certainly more of an interest rate sensitivity movement and pullback. But since in the latter part of 2023, we've seen some of the bigger direct office players that are revaluing their office valuations backwards to something sort of more realistic. So there's certainly been some softening in that area in commercial, but other parts of the real estate investment trust where our managers are investing for industrial, strong, retail is reasonably buoyant. So it's a diversified mix of assets there, Lee.
Thanks, Richard. And while I've got you, Richard, can I get you to talk a little bit about the portfolio positioning that the IC has been considering and actions taken recently?
Yeah, look, in 2023, like Mike said, we largely held the position with patience, and that we knew we had interest rate sensitivity in there. We'd be rewarded, and it was. But as we had some sense that 2024 might be a period where interest rates could come off, what we did is we looked at the fixed interest part of the portfolio, and what we had lightened up on in previous years with interest rates so low was what you call government bond or long duration exposure. And with that interest rates looking like up at 4 or 5% coming off in 2024, we've introduced more government bonds into our clients' portfolios. What that does, when interest rates ultimately roll off, soften, that's a tailwind. And it also gives us some protection should markets, equity markets, dip at some stage as well. So we've got back to bonds doing what they should do in the portfolio.
Thanks, Richard. Mike, you started to talk about outlook before, and you mentioned the outlook particularly for higher growth areas. Do you want to extend on that, please?
I think, as Richard said, I think the first half of 2024 is likely to be, a bit of a sideways, movement. The rally we had in November and December was pretty significant, and I think just to give some context, with Richard and I we were talking about real estate assets. I mean, the listed real estate index for the year did 17% return, of which 11.5% of that came in the month of December alone. So it just shows you how much a contribution occurred. So I think it's unlikely that investment markets rally really strongly in the first half of this year. And I think that's a reflection that central banks are going to be cautious in the timing of their interest rate easing scenarios. I think they will want to see consistent data that supports a softening in inflation, and I think even December and January we've had mixed data. So we had strong retail sales in the US and we had poor retail sales in Australia. So you're going to have this conflicting flow of information, I think, in the first few months. But I think the investment committee are relatively confident that the second half of this year we should see a lot of the inflation pressures ease off. The caveat for that is not too much more geopolitical storms that no one can necessarily predict. But I'm optimistic that the back half of this year will be a much better investment environment than what we've seen for the last couple of years, because interest rates are normal. So you're getting a decent contribution of returns from fixed interest investments. And the economy, it's a sort of, what we would call hopefully a Goldilocks economy, not too hot, not too cold, just about right. And that is really a good basis for which should be an okay investment year.
So if that okay investment year continues, Richard, one of the things that Mike alluded to before is that we saw in 2023 the Magnificent Seven contribute much of the equity growth in the market. Is there an expectation that in 2024 small caps may play a bigger role?
Look, the valuation in small caps in both international and domestically is good. And typically this part of the cycle is when the latter part of the cycle is when those sectors will rally. And the aim is portfolios are well positioned through what we call mid-cap stocks internationally and also small caps in the Australian market, Lee. So we've had pick up in those big stocks, but the smaller stocks will also follow through.
Is there any other factors that we need to be thinking about as we look towards the rest of 2024?
We've already seen here in Australia unemployment rates tick up a little bit. Yeah. And similarly, particularly in the white-collar professional services in the States, we have seen some jobs shed in that space. That's not a great scenario if you're in those job redundancies or job declines. But from a central banker's perspective, that is exactly what they want. They want some softening in the job market, because what it does is it reduces the wage negotiation tension when we have very tight employment conditions, and services inflation, which is professional services increase in costs, etc., is a contributing factor to the inflation numbers, and that's what central banks would like to see a softening of. So I think they're the two things, unemployment and inflation data are sort of quite coupled in that process. But if you think back to, from a historical point of view, full employment in the Western world was always perceived as 5% unemployment, and we are way lower than that. I think the official unemployment rate in Australia rose to 4.1% in the December quarter. So we have we're a long way below what is traditionally full employment, and that's why shortage of labour still persists in lots of skilled areas. Yes. And that is consistent across Australia and the Western world. So, I think I think economically, that's just a fact of an aging population, and the effects of COVID basically made cross-border employment more difficult because countries locked down their borders, made it more difficult for immigration, etc. And that's in the process of sort of unwinding post the COVID period.
Thanks, Mike. Richard, so I think what I've heard today is that 2023 was a year of the investment committee holding their nerve, if you like, and absolutely remaining committed to your investment thesis. Are there any changes for 2024?
At the moment, we're pretty happy with, largely happy with the settings in the portfolio, Lee. The overall positioning with exposure to both growth, interest rate sensitivity, what Mike said, in getting better bang for our buck in fixed interest. And that's really important for our retiree clients because they're getting decent yields, but also the portfolios, if interest rates come off, they look quite strong.
Yeah, great. All right, gentlemen, well, thank you very much for joining us today. I look forward to catching up with you again in 2 or 3 months and seeing how the start of 2024 progresses. Thank you.
Thanks, Lee.
Thanks, Lee.